Hello, welcome to our One Beautiful Bill Act Tax Changes and Opportunities webinar. I'm Justin Susi, and I'm joined here by Scott Jensen, who's going to present the materials to us today. And I will turn it over to Scott. He's got a lot to cover, so he's going to talk fast, and I'll gather questions. So if you have questions throughout the presentation, just put those in the Q&A for the Zoom, and I'll kind of organize those and come back to join you guys at the end. And with no further ado, take it away, Scott.
Awesome. Thanks, Justin. Really appreciate that. And just wanted to thank everybody that tuned in and decided to join us today. And we had a really excellent response to this offering. And so I think that this is an area that people are wanting to get some information on, and we're happy to try to deliver that for you. Before we dive into the actual content, just wanted to share a quick disclosure page with you. The highlights of this page that we need to make sure are clear is that we are not a law firm, we are not an accounting firm, so we're not providing any tax or legal advice by way of this presentation. We're going to not be providing any situationally specific advice, but just trying to keep it general and at a high level. We would advise any viewers or participants today to make sure you check with your own tax and legal advisors to see how these things may apply to you and before you do anything. Okay, so let's take a quick look at what we're going to run through today. This is sort of the lineup. We've got a lot of information, and so this is kind of how we're going to break it down. I'm going to spend just a minute talking about the history and framework of this bill, just to give you a sense of where this is coming from. We will then talk about key individual tax changes. This is where we'll spend most of our time here this morning. We will touch on a little bit on the estate and wealth transfer impacts, and then I'm going to give just a couple of items of business tax provisions, just sort of highlight a few. There's many more, but we're trying to kind of keep this more maybe geared toward individual changes today. And then we'll wrap it up with a few notable items that we won't have a lot of time to get down into, but just want to introduce to you. And our intent is that by the end that we still have a few minutes to answer a handful of questions. Because of the amazing response we had to this webinar, we realized that we will probably not be able to get to all of the questions. So we apologize for that ahead, but do want to say that if you're a GNS Capital client and we don't get to your question, we definitely welcome the opportunity to visit with you later outside of this webinar to help you understand how these things may be applying to your situation. The hope here is that we're going to go broad, but not as deep. And if you can pick up a nugget or two in this hour we're going to spend together, then hopefully this will be of good value to you. Okay, so let's take a quick look at the history and framework. The big, beautiful bill was signed into law on July 4th, 2025. And a lot of people are kind of calling this one of the most consequential pieces of legislation that we've had in recent history, mostly because of the breadth of it. The law itself started at over 1,000 pages, came in at 870 pages when it was complete. And by the way, not the largest bill ever. That came in at over 5,000 pages. But this one was very extensive. It covered priorities of 10 different Senate committees. Ultimately, when it was put together, we will not be talking about Medicaid, SNAP, border, judiciary, a whole bunch of others that got wrapped up into this bill. So we're only focusing and staying strictly with the income tax side of things. But it is very significant, and part of the significance of this bill is that our last major tax change that occurred in 2017, the Tax Cuts and Jobs Act, a lot of the provisions that were enacted then were scheduled to sunset or expire here at the end of this year. So it was really a bill that is changing things so that things don't go back to the way they were in many cases. It's a brand new baby. We're looking for further guidance as these things continue to unfold as well, since we're all of 3 weeks into this coming to be. Okay, let's dive into our individual tax changes. The first slide I want to share with you is just what's happening to the tax brackets. Overall, had this law, which I'm going to call OBBBA for lack of a better term as we go here, had this not been enacted, everybody across the board would have seen their tax rates going up. The lower tax rates that came in 2017 were scheduled to sunset, but ABBA has pushed these forward. So we see rates staying down, which is great. And with the rates being lower, what we're seeing from an opportunity perspective is that we think we now have a little bit more runway for folks that are interested in Roth conversions or accelerated IRA distributions, and trying to land those at these lower rates while we've got them. There's also one other kind of backdoor opportunity here, in that they are expanding the lowest two brackets next year just a little bit. And if you're in the lowest two brackets, you might be able to get 0% long-term capital gains. So there might be some tax gain harvesting. Sometimes we hear of tax loss harvesting. There might be some tax gain harvesting that you want to evaluate if you are somebody in one of those lower two brackets. The next big change that we had, the standard deduction. This was also scheduled to go back down. So in 2017, under the Tax Cuts and Jobs Act, the standard deduction was raised significantly, and that was scheduled to drop back down and really would have impacted everybody across the board. But they have extended this, and in addition to pushing it out, they've also put a little sweetener on there, so it'll be just slightly higher than it was originally scheduled to be this year, and that will be helpful for a lot of folks. This was an amazing change when it came in 2017. It really simplified things for a lot of people that were filing itemized deductions. Now, what we see in this arena from an opportunity perspective comes into play for folks that employ the bunching strategy. And so what we're trying to do is we're trying to accelerate itemized deductions into 1 year, where we can claim itemized deductions that go over this higher hurdle, and then in the next year claim the standard deduction. And so because this has been pushed out, we've got a little bit more opportunity to consider bunching strategies. I mentioned that the change in the standard deduction really helped simplify tax filing for a lot of folks when it came in 2017. And so I wanted to share a quick graph with you about what that looked like. Prior to the Tax Cuts and Jobs Act, you'll see there's about 3 in 10 taxpayers that were filing itemized deductions. And once that higher standard deduction came in, that number dropped to less than 1 in 10. So in 22, we see it was 9.5% folks that were claiming itemized deductions. So this really is a helper for folks. But the opportunity here is that if you found that you went from itemizing to claiming a standard deduction, there are a couple of other changes that have occurred that might prompt you to reevaluate whether or not itemizing is coming back to life for you, particularly the change to the SALT deduction that we'll talk about and some of the charitable contribution changes. So the opportunity here, take a look at whether itemizing is still available to you and whether you have a chance to do something under that. Okay, this one is fun. We've got 4 really kind of new tax deductions that have come in that we haven't seen in the past. The first one is called a new senior deduction. So this is a deduction equal to $6,000 for anybody that's age 65 and over. So 12,000 if you're filing a married joint return. It does start this year in 2025, which is exciting. You can claim this whether or not you're doing a standard or itemized deduction. So it's outside of the standard or itemized arena, which makes it kind of a unique tool. Now, the big part on this that I want to highlight is that there's been a lot of misinformation, communication, confusion as to whether or not Social Security is still going to be taxable. And in fact, you'll see a little quote here at the bottom that says, the new law eliminates federal income taxes on Social Security benefits for most beneficiaries. That was a mass email from the Social Security Administration after the enactment of this bill. But the reality is that your Social Security will still be includable on your tax return even after the passage of this bill. But what the intent was, I think, by Congress is that this new senior deduction help those folks that are receiving Social Security maybe have a deduction to offset it. But Social Security is still includable in income, so hopefully no confusion there. Sad part about this deduction, it does phase out as your income level goes out and up, and you can see those ranges here. The next deduction that was new and kind of interesting is that they have added a deduction for car loan interest. So we can now deduct up to $10,000 per year of interest paid on the purchase of a new vehicle. This one starts here in 25 as well. It does have a phase out. So once your income gets over these levels, 100,000 to 200,000, that will start to go away from you and be eliminated. But interesting new deduction to watch out for. I'm not sure that it's as exciting as it sounds. When I do the math and I think in terms of a new vehicle purchase for $60,000 at 6%, that's really giving me about $3,600 of interest. And so, yeah, yes, you could possibly get up to that 10,000. I'm not sure how that will play out with folks. Because that will phase out as your income goes up. You're probably not buying, as crazy expensive cars as your income allows you to grab this deduction. The two other of these four new tax deductions to highlight for you, they did come in and create a new deduction for tip income and for overtime income. The deduction for tip income will be $25,000. So if you're receiving tip income, you would have the opportunity to write off a deduction equal to $25,000 worth of that. And the overtime income, similar, if you have overtime income, a potential to write off $12,500 for single, $25,000 for married filing joint. And both of these kind of working similarly. So that's why I've tried to line them up side by side here with this graph that we grabbed. These are deductions outside of the standard or itemized, but they do phase out as well. And they also have a short runway, so they're going to be in effect from 25 to 28. The takeaway on these two, one is on the tip side, you can claim that deduction, but it is only allowed on reported tip income. So if you were receiving cash tips that were never reported, you couldn't pick up a deduction for it. So watch out, make sure that the tip income is being reported correctly on a W-2 if you're in that world. And then it doesn't apply to all occupations either. Oddly, they have carved out a handful that this will not apply for. So if you are a tip earning person, then kind of check out your situation. And then on the overtime, the key item here is that the deduction is only available on the overtime portion of your income. So in other words, if you earn $50 an hour and you worked overtime, so you got time and a half, you'd make $75 for that hour. It's only the $25, so that extra 50% piece that this deduction is available for. So not the full time and a half for the overtime hour, just the 50% upside. Again, this is one that will have to be reported. I'm thinking that likely you'll see a new line or a line being added to W-2s for employers to have to report this so that folks can pick it up. Okay, we're going to jump into looking a little bit more at the itemized deductions for just a minute here. Those four new deductions are all outside the standard or itemized arena. What we're talking about now are things that would apply to you if you were in the itemized arena. The first one, and one of the most notable items in the bill, in my mind, for broad appeal, is the SALT deduction. And what we're talking about here are state and local taxes that we have traditionally been able to deduct on Schedule A. When the Tax Cuts and Jobs Act came in 2017, it put a limitation on how much in total of these deductions we could claim, and they limited it to $10,000. It didn't matter if you were single or married, so there's a little bit of a marriage penalty baked into it. But it really put a pinch on folks that had high real estate taxes, high state income taxes paid. And so there's been kind of a fight over this one pretty much ever since 2017. But Congress did come in. They have raised the limit where we can now deduct $40,000 of SALT uh, SALT taxes, which is great. Does have a limited runway, but the upside is that it does start this year, which is great news. However, the upside will phase out. So as your income level goes up, you will not have the ability to grab that higher 40,000. You will still be able to float down and still get 10,000 potentially, but not the full 40. The other notable item here is that when the fight took place over this limitation, without getting way down into the weeds, there was a strategy called a pass-through entity SALT workaround that was put in play that the IRS said, yeah, that's great. Yeah, and the gist of this is that business owners with S corps, LLCs, partnerships, sole proprietorships had an opportunity to pay their state income taxes directly through their business and not bump into this limitation. So when we think about the planning side of this change, one is, can I now start to itemize because I'm going to be able to get more in SALT taxes? Now, two, can I do more with the bunching technique or strategy where I can maybe drag in 2 years worth of real estate taxes into 1 year, or maybe I can accelerate some income tax payments into 1 year, paying fourth quarter estimates in December instead of January, for example. Can I start to try and bunch that up because I can take more SALT deduction and use this bunching strategy? If you are a business owner, then what I would say to you is you're going to want to run the numbers to figure out what is the most optimal situation for you as to whether you're paying, taxes directly or through your business under this pass-through entity workaround that has been there. Now, the math may come out to where you find you can pay directly again, and it's better going that route. You might find that the SALT workaround is still the best play and strategy for you. Next item on the itemized deductions, just a quick highlight on this one. The mortgage interest deduction limitation in 2017 under the Tax Cuts and Jobs Act, we went from being able to deduct mortgage interest on loans up to $1 million down to only $750,000 of qualifying home loans. And this was scheduled to go back up. So this would have been one that would have been helpful had it sunset and gone away at the end of the year, but they have extended the limitation. It stays at $750,000. And the real notable item here is that they added back the ability to deduct private mortgage insurance. This has kind of come and gone over the years. Your ability to deduct the PMI that you might be paying on your home loan. That is back. It does start next year. So if you're paying PMI, watch out for that. Make sure that you're picking that up. Most 1098s for mortgage interest will report that and have continued to report that, but make sure that that's getting into your tax return if that applies to you. In the itemized arena, we've also seen some changes to the charitable contribution limitations. We're going to talk about charitable contributions for just a quick minute here as well. There were several changes that occurred there that I think are interesting and noteworthy. But the first one is that they have added a new limitation to charitable contributions. It's a floor of 0.5% of adjusted gross income that you have to go over before you can get the first dollar of charitable deduction. And the way this is really working is similar to the way we've seen the threshold for itemized medical deductions for many years, where you had to get over 7.5% to be able to deduct the first dollar of medical. They're doing that now with a floor on charitable. Now, it's a very low initial floor, but there's a 0.5% limitation there. Mathematically, what you're talking about is if you had adjusted gross income of $100,000, 0.5% of that would be $500. So when you went to Schedule A, the first $500 of your charitable contributions would not be deductible to you. You have to go over that before you got the first dollar. So the planning opportunity here is that if you are anticipating large gifts, you may want to consider the timing of those gifts, especially since this floor doesn't come in until 2026. So you may want to kind of look at whether or not to bring those in earlier or strategically when the best years are now to land them. As far as planning goes, use of donor advised funds to do some bunching strategies still in play. charitable gifting of appreciated stock is still in play. The use of qualified charitable distributions, QCDs from IRAs, that is all still in play as well. The other charitable item that I thought was notable, now this one is not an itemized deduction, but I thought it made sense to just chat about it really quick here while we're talking about charitable deductions. They have created a new charitable contribution deduction equal to $1,000 for single taxpayer, $2,000 joint for folks that are not taking itemized deductions. So if you claim the standard deduction and made a gift to charity, last year you really wouldn't have got much for that from a tax perspective, but now they're giving you the opportunity to write off up to $1,000 or $2,000 depending on your situation. We saw this a little bit around the COVID years. They introduced this concept for the first time then, but the numbers were, if I remember right, they're about $300 and $600 that they were allowing us to do for a very, very limited period of time. But this has come back in. This again has been put in on a permanent basis. And the one thing I would also say, and maybe pause for a second here, anywhere that you see permanent in these materials or in my comments, what we're talking about from a permanent basis really is that there's no sunset or expiration in it. But obviously, as the political powers change, Congress, future Congresses could do whatever they want. They could change any of these rules, when that happens. There's just no expiration or sunset already, identified. A couple of other notable items on this deduction here has to be cash donations. Cannot be donations of goodwill or ARC. Those don't work. Donor advised fund donations don't work either. And again, it's only for a standard deduction. The other really cool charitable giving item that we saw that popped in is that they have created a new tax credit equal to $1,700 for folks that are donating to charities that make scholarships for elementary or secondary school students. So we're talking like K through 12 scholarship help. And what's really amazing about this credit, it's very, very specific to the type of charity that applies to, but the credit is equal to up to 100% of your donation. And so if you were to make a donation to a qualifying charity of $1,700 of cash, you could potentially pick up a $1,700 tax credit on your return, thereby having it cost you nothing to help that charity in essence. This one does not start until 2027. And the reason is that they have put a little bit of work responsibility on the states to identify qualifying charities. I think so that they know who this will work for. I have highlighted one little graph here at the bottom of this slide where I've noted ACE scholarships. Some of the folks that are associated with our firm may have bumped into them either directly through the kind gifts they've made or other events that ACE has hosted. But Justin has been a longtime supporter, as has GNS Capital, of ACE scholarships. He's been on their leadership team. So just wanted to highlight that quick. We think that they will actually be one of the qualifying charities for this. So kind of a cool opportunity if you're charitably inclined, and one that may not cost you a penny to do that, to help one of these charities. Okay, jumping back over the charitable, or I'm sorry, over the itemized deduction arena again. Want to round out with just a couple of items here. This one doesn't apply to everybody. Definitely recognize that. But because there are folks that like to go to Blackhawk, Central City, Cripple Creek, whatever. Sometimes you'll see this in the tax arena, where you have been gaming or gambling and you've won, and you may have to report that on your tax return. Traditionally, you've been able to claim a deduction equal to the total of the gambling winnings that you had. It was an itemized deduction, but for example, if you won at Blackhawk and you got tagged with this Form W-2G saying, "Hey, you got $2,000 of winnings," it used to be the case that you could write off losses equal to $2,000 on your tax return as an itemized deduction, thereby not paying tax on anything. And I can tell you over many years, there's only one or two times where I did not have a client that had losses, gambling losses, at least equal to their gambling winnings. But what's happening here is that they're coming in and saying, we're only going to allow you to deduct 90% of your gambling losses. So if you had a $2,000 winnings and you spent all that money right back into the casino, you get to the end of the year, and what they're going to do is they're going to say, "Hey, we're only going to let you deduct $1,800 against that 2,000." So you still could have a little bit of taxable income hanging out. Now, dollars and cents wise may not mean a ton, but just one of those items that was kind of unique, and we thought we'd throw in there just so you wouldn't get caught off guard. Okay, two other pieces on the itemized deductions. One is that prior to the Tax Cuts and Jobs Act, we used to be able to deduct our unreimbursed employee expenses as well as our investment expenses. And under the Tax Cuts and Jobs Act, that went away, sadly. I will tell you that, unfortunately, it is not coming back. It has been permanently repealed. It was scheduled to come back into play. And one note from our side, our industry group, the certified financial planners, actually went to bat over this one and lobbied very hard to get this back into the tax arena so that investment expenses could be deducted. But sadly, they were not successful, and this has been repealed and has gone away. So miscellaneous itemized deductions basically still gone. But the one other interesting little note is that when OBBBA was passed, they added educator expenses as an itemized deduction, but not a miscellaneous itemized deductions. And so if you are a teacher, coach, educator, used to be able to deduct about $250 of out-of-pocket school supplies or materials that you're paying for. What we're thinking this might mean is that there's an opportunity for folks in that arena to hang on to their expenses, and they might be able to claim a larger deduction than they have been in the past. So if you know somebody in that arena or you're in that arena, that's one to watch for. Okay, the next one is personal exemptions. So what used to happen is if we had a dependent prior to the Tax Cuts and Jobs Act, we could claim a deduction equal to $5,300 for each of those dependents. So, taxpayer or spouse and our kids or whatever. When the Tax Cuts and Jobs Act was passed, they eliminated personal exemptions. That is now permanently gone. That is not coming back to life. And what's significant about this one is that had it come back into play, if you were a family of four, husband, wife, and two kids, you would have had about 21,000 more in deductions starting next year. But that is now gone on a permanent basis as well. Finally, on the itemized deduction limitation arena, um, prior to the Tax Cuts and Jobs Act, if you were a high income taxpayer, you potentially faced a limitation on how much you could claim in itemized deductions. It was called the Pease limitations after the congressperson that had put them in place originally. Those went away, but they were scheduled to come back. The good news is they did not come back. The bad news is that ABBA created a new limitation for high income taxpayers on itemized deductions and how much in total you can claim. If you are in the highest tax bracket, the 37% bracket, you will face limitations on your total itemized deductions moving forward. I'm not going to get into the math on how that all works, but I have added one note to this slide just to kind of show you what that range is. The 37% bracket starts for single taxpayers at 626,000 and married filing joint at 751,000. From a planning perspective, what this really comes back to is thinking about the timing on income and deductions. In the tax planning arena, typically, we want to delay the recognition of income when we can legally do that and accelerate deductions when we have the opportunity to do that. But what we want to do is now we want to really revisit where we've been, what we're doing currently to figure out, how do we want to try and structure our affairs, knowing that there are new limitations, there are new deductions, we've got new things in play that can impact decision making one way or the other and really change things for you. And in fact, just talking about a little bit of those deductions, just in the last couple of weeks, we have visited with clients where, one client, the bunching strategy, by being thoughtful and utilizing that technique, they will possibly pick up an additional $10,000 in deductions over the course of 2 years that wouldn't have been there. So that's just one simple example. Another one that we've seen, with a client recently, running some numbers and helping them think through their situation was the senior deduction. That was brand new. We'd been doing planning and kind of trying to target some specific tax brackets. And all of a sudden, this deduction has come in, and now they have an opportunity to perhaps accelerate some IRA distributions at lower rates or utilizing this deduction where they otherwise wouldn't have. These deductions for the new ones for the senior deduction, it's a use it or lose it. So we want to make sure we're optimizing that. The tips and overtime income, use it or lose it. So these are things that we want to just make sure we're stepping back, reevaluating where we're at, and looking at what does your situation look like. Okay, jumping out of the itemized deduction arena, couple of notes. If you have kids or dependents, the OBBBA bill has increased permanently the child tax credit amount. Before the Tax Cuts and Jobs Act, we used to be at about $1,000 per kiddo, and that went up to 2,000. OBBBA has sweetened that just a little bit, bumped that number up a little. The refundable portion has been increased. But again, this is a credit that will phase out as your income goes over 200,000 single, 400,000 for married filing joint. The other one in the child arena is if you are paying for child and dependent care, they put in a little bit more help for us in that area as well. This area has been enhanced. The child and dependent care tax credit, if you were getting that this year before the sunset, you would have been at $1,050, $2,100 if you have two or more kiddos. Under OBBBA, starting next year, so not this year, but next year, that credit goes up to $1,500 and $3,000. And the one that I thought was really notable in this arena, if you are utilizing an FSA through your employer to pay for dependent care, our limitation has been $5,000 for that. They have boosted that up, so we're now going to be at $7,500 moving forward. The planning opportunity here, take a look at your pre-tax opportunities with your employer and try to make sure you're taking advantage of what the new laws are allowing, especially when it comes to a deduction like this. If you can sneak in another $2,500 that you would be utilizing for childcare and have it run on a pre-tax basis, that's a nice little helper. Wanted to add a slide as well, just to give you a quick update on 529 plans. So these are the college savings plans. Um, these have evolved a little bit over the years. The most notable changes from OBBBA is that they've expanded the usage of the 529 just a little bit. Over the last few years, we've been allowed to utilize up to $10,000 of a 529 plan toward K through 12 education. Starting next year, that limit will go up to 20,000. So if you're paying for private schooling or K through 12 tuition, then you get a little bit of help starting next year. The other cool thing that came in under OBBBA is that they have expanded the definition of some of the education expenses. And so for the first time, if you're in the K through 12 arena, they have identified a handful of items that you can pay for that are not tuition. So tuition was the only thing we were able to pay for K through 12 coming up to this point, but now they're allowing us to pay for some additional items and run them through the 529 plans. And then if you're out of the K through 12 arena and you're at the higher education level, they have added two other new ones in here for post-secondary expenses where you can run costs of credentialing. So exams for licensing can now be paid for with a 529 plan, as well as some continuing education. So that's pretty new and kind of unique. From a planning perspective on this one, what we would suggest is take a look at your 529s, how you're utilizing them, try to make sure that you're taking advantage of them, the best you can. sometimes what we see are folks that utilize 529s well. Other times they're like, yeah, we haven't really saved a lot for college that way, so we think it's sort of off our radar. I would ask you to pause for just a second if you are a Colorado resident, because there may still be an opportunity for you here. And what that opportunity is that if you make a deduction to a Colorado 529 and you are a Colorado resident, you can pick up a Colorado state income tax deduction. And there is no seasoning requirement for how long that money has to stay in the plan before you can use it. So in essence, what you can do is say, okay, I've got to pay, $20,000 of tuition this year. I'm going to make a deduction or a contribution to the 529 plan, and then almost immediately pull that out, pay the tuition. So it hasn't been in there really for any great length of time, but by running it through the 529 plan first, you can pick up a state income tax deduction. So kind of a cool opportunity. Just in fact had a conversation with a client this morning, about that opportunity in Arena, and that was brand new to her. She had never realized that she could pick up a Colorado deduction for that 529 contribution and utilize it in that way. So there's one to think about as well. Okay, coming down the home stretch on the individual tax items, want to introduce a new savings account that just came to life under the OBBBA. This is being called the Trump savings account. I've seen it referred to as a MAGA savings account. I don't know what the final term ultimately will be settled on. My hunch is the Trump savings account. But what they've done is they've created a new vehicle for saving for retirement intended to be started for your kids. It was sort of a surprise, I think, in the tax arena, because we've already had, UTMA accounts, custodial accounts, 529 accounts, and for kids that were working part-time, we could do, IRA contributions and Roth contributions. So it was kind of like, why did we need this? But when we look at what they're doing here, it is kind of unique and interesting, and wanted to make you aware of what's happening here. Basically, this account will work similar to a hybrid Roth IRA, is the best way I can describe it. When you make a contribution, there will be no deduction. So that's sort of like a Roth IRA. Um, the account will still grow on a tax deferred basis, so you're not paying income tax, each year on earnings or growth. But then on the back end, whenever your child would take money out for a withdrawal, it will be taxed. So that's more like a traditional IRA. So we're sort of in this hybrid arena. No deduction when it goes in, can grow tax deferred, but we've got to pay tax when it comes back out. What makes this account really interesting, I think, is that the government is offering to put seed money in the account for any children that are born in 25, 26, or 27. Very unique. They will put $1,000 into that account to get it started. Very interesting that they are willing to do that. There's a lot of guidance information still needed as to how will accounts be opened, how will those funds be transferred? Will it look like a direct deposit of a refund from a tax return where they just put it right into your account? How will you initiate that? One of the other things that is interesting about the accounts, you can open them from 0 to 18 years old. You cannot take a distribution for any reason until they hit 18 years and old. Once they get over 18, now it looks more like the way you think about an IRA, where you could take a withdrawal, but you would get penalized for doing that until you turn 59 and a half. So a little bit of nuance to these accounts. Definitely more guidance needed. We don't know if you're going to be able to roll these over to a Roth or an IRA once they turn 18. There are also limitations on the maximum that can go in each year for the kiddos, $5,000 in total, and that can come from any individual contributing on their behalf, or they have identified the government because they're going to put some seed money in if you're eligible. They've also said employers may have the opportunity to add to these accounts as well. So that's one to watch out for. The accounts, as I understand it, cannot be opened until 2026 at the earliest, even though you can still maybe pick up that $1,000 seed money if your kid was born in 2025. And then the last thing I want to talk about on the individual side ABBA was very significant in that they really shut the door on the tax credits that we had in the tax code for green energy. There's many more that got shut off than what I have highlighted here, but I wanted to at least kind of give you a quick rundown of some that we think are notable. The new or the credit for new EV clean vehicle purchases is ending this year. Gone is the alternative fuel vehicle refueling. So this is the charging station that you might put into your house. That's going away. Energy efficient home improvement credits, those are going away. Gone is the solar credit. But watch for the dates. There is just a little bit of runway left for each of these. If you are looking or we're thinking about a new EV vehicle, the time to do it is now. You basically have only about 60 days to do that and still pick up that credit before it is gone permanently, as long as permanent lasts, like we talked about. But before it is gone, so watch out for that date. If you do get a new, energy efficient vehicle, then you'll have a little bit more runway to get that charging station put in. They're giving us till midsummer next year for that one. But energy efficient home improvement credits, they end at the end of the year. So windows, doors, insulation, if you were doing any of those kinds of things. And the one that I think is really big is the solar credit. This I've seen over the years really could add up to some significant tax dollars because it was 30% of qualifying solar purchases. So if you'd done a $20,000 solar installation, you might have picked up a $6,000 credit on that. That's going away. And my note in thinking here is that if you want to do this, you really are going to want to move soon, because my hunch is that as the farther we get into the fall, the folks that do solar are likely going to see an uptick in demand. And the farther you get into the year, it may be difficult, if not impossible, to get it scheduled and installed by December 31st. So it's not just paying for it and ordering it, it actually has to be put in place. Okay, let's jump over, talk for just a minute about estate and wealth transfer impacts. The big news here is that the estate exemption that was scheduled to sunset and go back down has been extended. And it's been extended on a permanent basis and inflation adjusted. So still indexed to kind of go up each year. Prior to this, most people in the estate planning arena we're looking at this sunset and really thinking, wow, we've got to get stuff done this year. This is going to go back down. We're going to lose the ability to make some of these larger gifts. But the good news is it has been pushed out. And what else is pretty cool about it is they are giving us a larger number starting in 2026. So we're going from nearly 14 million in 25 up to 15 million starting next year. Also wanted to highlight the state tax maximum rate did not change. It stayed at 40%. Likewise, they have not made any changes to the annual gift exclusion. That's staying at $19,000 for this year. On the planning side for estates, if you're in this world, we think that the use of gifting programs, grat trusts, slat trusts, intentionally defective grantor trust, they're still all in play. And maybe we don't feel the same urgency to do something quicker than we're comfortable doing. There's still a little bit of time. We've got a little more runway now to do that in a thoughtful way. With the new Trump accounts coming in, if you are doing annual gifting, we think it's an opportunity to really consider where do you want to make those gifts, and trying to layer in the Trump accounts, maybe with the 529s or annual outright gifts that you're making. Dynasty Trust, Charitable Trust still alive and well. And the other opportunity or planning item I would note, even if you're not in this arena, this is a time to really evaluate your estate plan. We now know what the rules are going to be for the next several years ahead. So it would be a very opportune time to visit with your attorney to make sure that what you've got still works. We've seen over time where sometimes clauses or provisions were drafted years ago when the estate exemption was much lower that just don't work well anymore or operate how they were intended. And the other note on this one is that some people may have been flirting with this arena and going, hey, I don't really need to do anything now. I would say maybe reconsider that thought, because even though the estate exemption on the federal level is pretty high and staying pretty high for the foreseeable future, there are some 20 different states, as I understand it, that have either an estate tax, an inheritance tax, or both that could be at much lower levels. So you want to still make sure that things are working for you. At GNS, we have invested in tools to help our clients evaluate their estate plans. We're trying to help set them up with ideas and strategies that they can then take to their attorneys to work with them on. So take a look at that one in the estate arena. Okay, I promised it wouldn't be super long on business provisions, but did want to highlight three very, very quickly as we kind of come down the home stretch here before we jump into some questions. The first one is the qualified business income deduction. If you were in a pass-through business and were picking this up, this deduction was actually scheduled to go away at the end of this year. And I think that would have not only been a surprise to a lot of folks in that arena, it would have been a little bit painful too. But they have extended it. They've extended it on a permanent basis, and they have expanded it just a little bit. The planning opportunity here and suggestion is that you consider revisiting your calculations and setup for the QBI because it has been expanded just a little bit. If you're trying to optimize this, the numbers are going to change on you just a little. The other business item that I wanted to highlight that I think we've got a chance to do something with right away is for business owners, you may have a chance to accelerate some asset purchases into 2025 that perhaps you were not planning on. If you were thinking of new equipment or assets into 26 and thinking, we'll see what happens in the tax law. Well, the tax law has now happened, and where we're going is we're going from limited depreciation and the ability to claim bonus depreciation up to something a little bit better. I've added a graph here just to show you quick. If you were a business owner, if you were buying qualifying property, for a while we were able to take a bonus depreciation up to 100% of the cost of that. That was tailing down over the years, and so here you can see where it got down to only 40% bonus depreciation here in 25, and it would have been as low as 20% next year. But they've brought bonus depreciation back to life. It's equal to 100% again for qualified property. So you might be able to pick up higher deductions by accelerating those asset purchases into 2025. And then the other note is that if you were utilizing Section 179 to make the expense election on those assets, that maximum has gone from 1 million to 2.5 million. So business owners, take a look back at what you're doing on the equipment purchase side. Last business item. This one is noteworthy to me, partly because of how long it's been around. They changed the 1099 NEC reporting rules. These are the forms that business owners would issue to a contractor when you pay them over $600 for their services during the course of a year. And I am hard pressed to remember any point in my career that the number and threshold was not $600. Finally, after many, many years, they have increased the threshold going up to $2,000. So yeah, hopefully what that will mean is a few less folks that you have to issue those 1099s for. But that does not start until 2026. So it's not for the payments that are occurring here in 25 that we'll report in January, but it'll be for what the folks you're paying in 26 that you would be reporting the year after. My additional notable items, and we'll grab our questions. I'm only going to hit three on here. One is qualified opportunity zones have been expanded. There is some significant capital gain deferral and reduction planning that's available under those. That if you have large capital gains, you might want to revisit that. R&D expenses, we've had to be amortizing those the last few years. They have now said that we can expense those at 100%. And the cool part about this one is they're allowing some retroactive treatment going all the way back to 2021. So you may have a chance to go back, amend some returns, and pick up some deductions. That one's really pretty cool. And then the ERTC, saw a lot of clients that were able to grab this employee retention tax credit. They have closed the door on that program. It is done. There was a lot of abuse that took place. They have enhanced the penalties on promoters, and they have also extended the examination period if you claim the ERTC. So the note here is hang on to your your materials, your documentation for that longer than your normal statute of limitations because they do have a longer period to come back and check that out. Okay, many more items that were in the OBBBA. There were over 100 tax changes. We certainly can't get to all of them here. Tried to give you kind of a look at a bunch of them really, really quickly. I'm going to close out before you hit questions with just telling you quickly a couple of items that there was a lot of chatter about that did not get included in OBBBA when it was passed. The first one is that there was some conversation about whether or not they would eliminate the tax exempt treatment of municipal bonds. Now, that did not end up in the final bill when it passed. Tax exempt municipal bonds still remain tax exempt. So that's really good news. I think that allowed some of our clients to breathe a sigh of relief. Congress also did not increase the corporate tax rate. There was some conversation about whether that would happen. There was communication about whether they would eliminate step up at basis. That did not go away. They also didn't mess with the carried interest rules. And the very last item that I snuck in here at the last minute was one that kind of caught my attention really in the last few days. They did not enhance the advanced premium tax credit. And this is a credit that comes in if you are obtaining health insurance through the exchange. Many people pick up a tax credit toward the premiums that they're paying for health insurance. When the exchange originally opened, there was not as many participants as they had hoped with the credit that was available. So they enhanced that credit, and that drove more people into the exchange. And so there's a lot of folks out there that are getting the credit that may get surprised at the end of the year when they learn that that credit is going away for them. So you may get a double whammy where the insurance premiums going up. Some carriers are saying as much as 10 to 15%. So you might see the premium go up and lose the credit on the other side and really kind of get a double whammy. Want to at least highlight that if you're on the exchange, take a look and see what that might be doing to you going forward. So that's a whole lot of information. We still have a few minutes for questions. Have Justin jump back in here and see what he can offer. Again, would tell any of our GNS Capital clients if we can't get to your question or you have other items you'd like to look at together, call us. We'd love to look at it with you. We've got some really great tools to help evaluate how these new laws apply, putting a pencil to paper to your situation.
Thank you, Scott. Yeah, take a deep breath, have a glass of water.
Yeah. Oh my gosh. Yeah. I went fast. I know it. I threw a lot of info out there. I hope you guys were able to digest it and try and grab it, but I wanted to give you very broad exposure. Yeah.
No, it was great. I'll let you catch your breath here. I'll take the first question. But one was a question around, even though the Colorado 529 plans or 529 plans in general, where they've kind of opened up that window for K through 12 expenses, that's kind of at the federal level. And again, we have clients in 30 plus states. So again, we got to check out the specific state. Colorado, where most of our clients are, they still do not consider that a qualified withdrawal on K through 12 education.
Yeah, thank you for highlighting it. Yeah, we should make that very clear and very specific.
Yeah, and I don't know why. I don't know, some of these things you'd think they'd be a little more together with on the states with the 529 plans, but yeah. So that was one question we had. You could still take a withdrawal.
A quick note on that too, Justin. That's a really great example as to why we don't want to talk situationally specific, right? The best thing you can do is visit with us if you're a GNS Capital client or with your CPA. We love working collaboratively with them, with your attorney, and really see how are these things impacting you and what are the specifics based on your individual situation.
Yep, absolutely. One other question too, the SALT deduction, if you were someone who was running that through your business or your S Corp and you were kind of getting the benefit of that, did that go away because of this, or can that still be continued?
The pass-through entity SALT election is still alive and well. So even though the limitation is going up on the itemized deduction side, if you find you're a high income earner and you're not able to grab that because you're still limited to that 10,000 or whatever, you can still run that through your business, still use that same strategy. But the real note is just if you're kind of in the in-between arena, is to really take a look and put a pencil to it, figure out what is the most optimal situation for you.
Great. One other on the Trump savings account. Do you know if these are going to be, will people open those with us, with Charles Schwab as a custodian? Will these be government opened? Is it too early to have that information? And I guess one reason I ask is, you look inside the Social Security box, for all the money that's supposed to be in there, and it's like, okay, where is it? It's like people might have more faith or confidence if they can open it somewhere outside of the government.
Great question. This is one where, I mentioned there's really more guidance that will be needed. A lot of provisions in OBBBA that will be looking for Treasury regulations, Treasury revenue procedures to help define these things. My understanding at this point is that these are going to be individually owned accounts that are not not operated like Social Security, where we're all throwing it into a fund and hoping that they keep track for our individual basis when we get to ready to take something out. It will be an individually owned account. But as to whether that lands with a Charles Schwab or some other governmental institution, I don't really
Yeah.
have the answer to that one yet. That's a kind of wait and see. And I think part of the reason that these aren't really going to be starting until the early part of 2026. They've got the idea out there, but now we got to figure out how do we actually implement and put this in place.
Yeah. Yeah. No, sounds good. I'd feel more comfortable if it was open somewhere besides the U.S. government.
I do,
Um,
and not to scare anybody, but you mentioned Social Security in that same breath. Some of the tax folks that I follow and kind of watch their communication and analysis, they are thinking that this is the first uh, sort of, I guess, attempt at privatization of Social Security, that they want to set up a retirement account at birth with the government possibly adding some contributions along the way. Maybe there will come a day where employers are deferring, Social Security money directly into these accounts where the government gets out of the business of Social Security altogether. And I'm not saying that's what's happening, but there's folks that think this is sort of a little experiment that they want to see what happens and where it goes. Now, for now, I'm like, hey, let's just understand the rules and take advantage of what they're giving us the chance to do.
yeah. No, I agree. I'm all for they got to address Social Security here, in the near future for sure.
Yeah, so maybe not a coincidence that this is popping up right now where we're headed toward, some significant issues.
Yeah. No, that's great, and that's all the questions we had. So again, it looks like we might be able to get in at the hour mark here on this. I just had a couple of things. Again, Scott mentioned all these things, but just a couple of quick highlights on the gifting strategies. I think there's still a lot of people that are doing great charitable things with the gifting, but if you're unsure of whether you're doing that in a really effective way, just call us, because again, whether you're doing a qualified charitable distribution as a gift, or whether you're using a donor advised fund, or you're gifting a highly appreciated asset, for a lot of our clients, probably the most inefficient way to gift is just writing a check. So just check with us on that, and we're happy to kind of look at your situation. One of the other things that Scott did mention, the IRA distribution planning, the Roth planning, we're doing that with a lot of you, but that's just taking into consideration while we have these lower tax brackets, can we sneak a little more IRA money into more favorable accounts at lower rates before maybe rates go higher down the road. And then last but not least, we're recording this, so we'll distribute this out as well. So in case you want to rewatch a section of it or pass it along to a friend, family member, colleague, happy to have you share it with other folks. And once again, want to thank you, Scott. Scott's our wealth planning specialist. Obviously, you can see he's got a ton of knowledge and a lot of depth in these subjects. So appreciate you putting this on and enjoyed it thoroughly.
My pleasure.
And
Thank you.
yeah, and thank you to all of our clients and friends and family. Appreciate you. Thank you.